With gold rising in popularity as an investment base, what should an investor be aware of, and where is a good place for your money? Paul Burton joins us now from Piran Mining Research. Paul, welcome.
Good morning.
How do you start by putting together a gold portfolio of investments?
There's obviously quite a number of avenues one can go down. So I think, firstly, the investor has to accept that they want to be in the gold market generally, and it's often as a counter to maybe the stock markets or the bond markets. Then there's, depending on their propensity for risk, there's various ways of getting involved in gold. There's obviously through the bullion market. Bars and coins, not always the easiest thing to acquire. But then you have a proxy for bullion, which is the gold ETF, which trades like a share on a stock exchange and is ostensibly backed by gold. So that's one way of getting in easy. And that's really and that fact drove the market up to its highs of over $1,900 an ounce in 2011. It was the availability of this instrument that people could understand and use easily to get their hands on gold. And then, of course, the highest risk area is actually in gold mining companies or exploration companies themselves.
That's an interesting point, because talking about the high risk is that I've noticed over the last 4, 5, 6 months or so, there has been a larger increase in shares, the value of shares in the gold sector, rather than the price of bullion.
Yes.
So there is this levering up, isn't there?
There is indeed. There's various technical ways to describe it, which we won't go into here now. But yeah, generally gold companies do exhibit this leverage to the gold price. So for instance, gold price went up 24% this year so far. A number of companies have gone up far in excess of that, maybe 100, 200%. And that's the leverage. That's what's one of the attractions of actually investing in a gold mining company share as opposed to the underlying bullion. You have this opportunity to have even greater increases in the value.
What about where these gold companies are? You talk about risk. What sort of risk are you taking on when buying into shares of gold companies?
There's obviously a technical risk. If you buy a bullion coin, you hold it in your hand. If you buy a mining company, it's still in the ground, the gold. So you've got the technical risk of actually getting it out and then getting it to the market. So, and there is some degree of risk in, more than a degree of risk in some of the countries that gold miners have to work in these days. Obviously, a lot of the easy gold was found many, many years ago and in the safe jurisdictions. And unfortunately, Mother Nature has placed the gold where it is. We can't move the factory. So if the company's working in the DRC, for instance, if you're an investor and you see a company producing gold there, you have to accept that there is a country risk. Often companies will spread their internal risk by operating in several jurisdictions. So that's one way of getting around that risk. But it's up to the individual investor to see what their risk propensity is, to see which companies they actually preferred. So sorry, just to finish, but some companies will say out of Canada, we only invest in the Americas, we'll only operate in the Americas because we don't want risk of some of these more exotic jurisdictions.
What about the way in which gold is mined these days? Because when looking at a gold company, I mean, it's been a long time, I think, since people have been digging nuggets out of the ground. The last 2 or 3, 4 years, gold has seen a big downturn, and of course there's been a lack of investment in new projects. Do you see new projects coming online? Are companies now more willing to invest in new operations? I'm thinking of the exploration, which has been we've been avoiding over the last few years because of the costs involved. A lot of the smaller companies, of course, have gone out of business because the gold price has gone down. Are a lot of these old projects now being turned back on, and do you see more investment opportunities because of more exploration?
There's a couple of things. Yes, with a higher gold price, projects that have been put on the back burner will start to look more attractive, can be reinvestigated and might well be brought through. The problem the industry faces is for 7 or 8 years, as you rightly say, there's been very little investment in exploration. When the price came off the highs in 2011, one way of cutting costs was to cut exploration. So sacrificing the long-term future of the industry for short-term survival, really. So there is this lag. There's been a lack of exploration spending around the world. Exploration budgets have been slashed. And it takes time, starting from a new find to actually getting to gold out of the ground can take 7 to 10 years. So this is one of the big constraints in the industry going forward. There's likely to be shortage. We've probably seen at least for this cycle, we've probably seen the production, gold production peak.
Well, we're hearing a lot about demand from the likes of China, Russia. India's always been, obviously, for different reasons, but India's always been a big demander of gold. But with this large demand on the sector, do you see much of the price rise coming that many are talking about because of the fact that there's a lack of new gold mines coming on stream, or is it just because of the fact there's just not enough gold around?
Yeah, it's an interesting dynamic. Gold is unlike other commodity markets because of this huge inventory on surface. Every ounce of gold that's been mined is still sitting there somewhere, available to come back into the market at the right price. So a lot of analysts will say, well, it doesn't actually matter about the primary mine supply, but it does when because it affects the base price, I believe. In 2001, when we saw the last bottom in the gold price at $250, it just happened to be the price of getting it out of the ground. When we saw the recent bottom is at $10.50, that just happens to be the average price of getting it out of the ground. So there is that factor coming into play. But there will be, there is a lack of gold coming through, and we're starting to see more demand. It's coming through ETFs. The Chinese-Indian factor has been less influential in the last year or so. Gold has been driven by what we call the fear factor rather than the love factor. So it's people trying to protect their wealth, and one of the ways of doing that is to obviously invest in gold, and the easy way is through ETFs. So we've seen a huge surge in ETFs this year. It came off in the last week or so again, but and that's one of the things that's been driving the gold price this year.
Just one final thing. At Piran, I know you put these portfolios together. What is the best way to approach portfolio investment? I mean, we talked about 3 particular big areas. How would you split that between shares, the ETFs, and bullion?
Yeah, again, it comes down to the individual on what their risk propensity is. If you accept that out of your portfolio of property and everything and bonds and stocks, if you say 5 to 10% in gold, then you split that 5 to 10% down into the particular areas that we looked at. So I would probably say 30% in gold bullion, probably another 30% or 40% in not quite blue chip, but some of the majors or mid-cap mining companies who are going to move and also paying dividends. So there's a dividend return, and you've also got capital appreciation. But then if you have the right, if you are not too afraid of risk, then you go into the very risky area of your exploration stocks, and that's where you're going to make, you have to see the 10 baggers. That's where you're going to make a lot of money if that exploration company finds gold.
If. Oh, it's always a big way, is if. Look, Paul, we've got to leave it there, but thanks indeed for joining us. That is Paul Burton from Piran Mining Research.